Welcome back to Revenue Margin, brought to you by Rob Malenik. I want to talk today a little bit about business startups and what truly makes or breaks them from overall, statistically saying. Most people think about startups, they think about big ideas, innovation, and growth. They think about that local restaurant that got opened up, a new concept. And they think, gosh, that business that just opened up down the street that it was there for like a year, it failed. Must have been because nobody wanted to buy from that location, or a product line that nobody really wanted to buy it, so that's the reason why they failed. And to be honest with you, most of the failures aren't because of market demand. 70% of all failures are due to financial mismanagement. After working with founders and scaling businesses from zero to $1 million in revenue, I've seen the same financial issues derail promising companies over and over again. Here are the big ones that consistently fail companies. Number one is not understanding that cash flow is king. People focus so much on revenue. Revenue is just vanity at the end of the day. The next they'll say, look, and I'm super profitable. Yeah, it shows the proof is in the pudding. You're right, there is a product line offering there. But unfortunately, you could have both revenue and profit and still fail. Like how does that happen? And that's because cash flow is the one key thing that most business owners forget. Startups often confuse booked revenue with cash in the bank. If you don't understand your burn rate, your runway, or the working capital cycle of your business, you run the risk of losing out on the cash flow. I've seen many, many businesses that are very, very successful fail because they don't have enough money in the bank to pay their bills, and ultimately they lose that credibility and they have to close because they don't realize that the revenue that they book today may not come in for 30, 60, 90 days. Maybe they launch a new division and have a major customer that's way bigger than they've ever had, and they fail because that business doesn't pay them when they agreed to pay them. What are you going to do in those situations? If you don't have enough money, you don't have an investor, you shut your doors and you go to court and your business is done. Second is underpricing. Underpricing is sneaky because it's so much easier to sell something when it's 50% off. We all buy things at the grocery store that are 50% off. But founders that really think that a price competitiveness only and really maybe undercut the marketplace, realizing that yes, they get a whole bunch of revenue and on paper they might feel like they're profitable, but a lot of times they're not covering overhead, they're not covering taxes, they're not covering something that's sneaky called reinvestment. And what I mean by that is that reinvestment, if you have like a landscaping business, a lot of times these companies are like, look at how profitable I am. I bought all this equipment for $3 million, and I'm producing now $3 million of revenue a year with $300,000 worth of profit. And I'm like, great, you're going to be a failure. And they're like, what? How is that possible? I was like, what's the useful life of your equipment that you're using? They're like, 5, maybe 6, 7 years if I'm lucky. I'm like, great. So the profitability you made for the $3 million investment of buying that equipment means that you're not going to have enough cash flow to repay for that lost equipment that you don't have in 5 to 7 years. You need to make a lot more money than what you have right now versus what you've put into the business to be able to replace that equipment long term. So you have to understand what your pricing strategy means. And so if you don't make enough money early and understand what level you need to be at, it's going to only get worse as for time and scale and potentially cause you issues in the future. Third is a lack of financial visibility. So what I mean by this is that a lot of good businesses don't have a dashboard. They have no forecast. They don't have a 13-week cash flow statement. You're not forecasting weekly in that early days. You're ultimately really running blind. Startups need to be forward looking on the finance side. Having a bookkeeper to close the books is required, of course, but that bookkeeper isn't going to give you what truly you need from a financial perspective to understand what you need to do from a visibility perspective long term. In addition to that, there are things that might occur, an environmental disaster in your market, had this happen for one of our clients, and in their market, they had environmental disaster. It shut down production, and to be able to be there for their employees, they said, "I'm going to keep the doors open." My heart goes out to them. That's amazing. Thank you for doing that. But they did not have a long-term forecast for how long they could do that for. They burned through a large portion of their cash, and at the end of the day, they couldn't get the business up and running again because they needed money to be able to produce product to be able to then sell, and they had kept a lot of their money and given it to their employees, and so they struggled to be able to be long-term successful for their organization. Fourth is mixing personal and business finances. So what this means is that a lot of companies that get started up, the owners actually keep their businesses and their personal finances in the same account. And this is really a dangerous thing because they will either subsidize the cost of their business through their own personal savings, or two, it actually creates tax risk because I've seen this happen for a lot of organizations where they'll run personal expenses through their business to be able to get tax write-offs. That is illegal and is potentially causing your organization to be at risk with IRS. And lastly, too, is that it does cause reporting confusion because ultimately a business that wants to get financing from a bank or be able to present to investors, in that due diligence that the bank and the investors do, they might find inconsistencies about why are you paying for this bill? Why did you pay for Joe's education? Why did you pay for the purchase of this trip? And why should we invest with you? You lose credibility associated with those things. Very, very bad to mix all of that. Keep the business and the personal separate. Fifth is actually hiring too fast or too slow. Payroll is almost always the biggest expense for an organization. Hiring before revenue is predictable, destroys cash. Hiring too late limits your ability to grow. There's got to be a discipline in financial modeling to really help you understand when to purchase that additional equipment or payroll, and you really need to be able to think about this long term. And so when you go through that, having a model put together so you understand it is critical, because I've seen a lot of businesses say, gosh, my people are overworked, we're at capacity, but the cost of hiring a new person is $100,000. So I'm going to go and hire somebody for $100,000 when I'm only making $50,000, and hopefully we'll grow. Well, maybe you should have hired a temp employee, even though they might have been a little more expensive. Instead of losing as much money, you could have actually slowly scaled it up, and then maybe hired that person full time once you scaled, even though there might have been a slightly higher cost for the fractional employee. The truth is, startups don't need just a bookkeeper. They need financial leadership, even if it's a fractional basis. Focusing on cash flow strategy, pricing discipline, capital allocation, long-term stability, long-term reinvestment requirements in the business. If you treat finance as a strategy instead of a compliance requirement, your odds of survival and dominance in the marketplace increase dramatically. Because growth doesn't kill startups. 70% of all failures are due to poor financial decisions. Thank you once again for being here for an episode of Revenue and Margin. If you have any questions or comments, please put them down below. I would love to hear from you to talk about how we can potentially help your business moving forward. Thank you once again, and see you on the next podcast.